Hello and welcome. I'm Philip Alexander, speaking from the IMF and World Bank annual meetings in Washington 2014. With me is Simon Johnson, Professor Simon Johnson from MIT Sloan School of Management and a former chief economist to the IMF. Simon, you've written quite extensively on the financial crisis and in particular a focus on the problem of too big to fail banks. Now, we've seen Mark Carney at these meetings telling the International Monetary and Financial Committee that if the deal that he wants is done in November at the G20 meetings on cross-border recognition of bank resolution, then we've pretty much tackled the problem of too big to fail banks and banks are now safe to fail. Do you feel that's right, or is that too optimistic?
Well, I am very supportive of Mr. Carney and this cross-border resolution work, but I think it is now and will also by the end of the year still be premature to say that too big to fail is in some sense solved, or even that it's receded in terms of its importance as a public policy issue.
And what are the main obstacles that still have to be crossed, and as to why it's still such a problem or a risk?
Well, in the US context, remember that all of these banks are mandated by law, by the Dodd-Frank law, to have a so-called living will, which specifies how they would be managed in the event of a failure. And this is supposed to be without public intervention, no public money, no use of special resolution powers. Those are for emergency use only. So where are the living wills? Where are the documents that would show the regulators that these banks can actually be taken down in an organized way without creating a global panic? Those documents don't exist. There are some things on paper, but they've been deemed unsatisfactory by the regulators themselves. So we have no living wills. We're not really solved any part of the too big to fail problem until we have those roadmaps.
And in terms of obviously some of the efforts around bailing in and total loss absorbing capital, do they solve the problem? Are there other problems attached to that in terms of, obviously when a bank fails, the loss is somewhere, and are we any clearer about who takes the loss and whether that loss is going to be manageable?
There's still a huge amount of uncertainty about who bears the loss and whether that be manageable. It is very good that there's more discussion, including this week, about loss absorption capacity. What exactly does it mean? And I sense a move in the official consensus towards focusing more on shareholder equity. I think some of the discussion that brings in contingent capital is a mistake. There's a lot of times you can't pull the trigger on those contingencies. Also, the magnitudes that people are discussing are way too low. In Thomas Hoenig's Global Capital Index, Mr. Hoenig is the vice chair of the FDIC, the largest global banks have about 3 to 5% equity, so that's 97 to 95% debt. We need to move that number a long way to at least 10% equity, some people would say 20% equity, to have a really strong, robust buffer against potential losses.
I guess the other issue is this question of systemic risk. What we've seen in the past is that large banks don't tend to get into trouble individually. It tends to be the system as a whole, a lot of large banks in trouble at the same time. Is that still an issue, that when that happens, a lot of the sort of resolution mechanisms, the idea of being able to do it without the taxpayer really potentially goes out the window?
Yes, I think that's a very important point. Today, probably we're better placed if just one very large bank were to fail or be close to failure by itself, sort of in isolation and in a period of relative market calm, if you can imagine that scenario. But of course, that's a very unlikely scenario. Much more likely is that some form of interconnection or correlation of decisions between these banks, or correlation of shocks, means that you've got 2, 3, 5 of them in trouble, and then the regulators and supervisors' instinct is to shore up the system, prevent the panic from spreading. Well, how do you do that? You inject resources one way or another. You might call it liquidity, you might call it capital, you might call it something else, but you're providing public support to these private firms, and that's exactly what we did last time.
And you talked about living wills and the need to do more. Obviously, you mentioned more capital as one route. What else needs to be there for a living will to be a convincing document that could genuinely be followed in the event of a crisis? What are the other bits of the puzzle that are missing still? Well,
I think it's really about complexity, or perhaps more accurately, simplicity. Is the structure simple enough, both internally and in terms of how it's connected with the outside financial ecosystem, that you can unravel the pieces and say, okay, this bank goes down, we know that this person's in trouble here, and there's a spillover effect on this country there. And then the regulators or other responsible national authorities, perhaps involving the IMF, can take some preemptive action, and you can stop the panic from spreading. Remember, the crises we've had in the past, both 2008 but also the Asian crisis, 1998, you can go back to the emerging market debt crisis, early 1980s. The real problems are when you don't know what where is the next domino? Who is it? And all of a sudden it pops up and it turns out to be somebody's hedge funds from some other country that was invested in this third country. Oh no, my goodness, now we've got a problem over here. That's what you've got to move away from. And we've been doing this for 30 years, speaking globally. Do we really know what are these interconnections? Do we have this kind of real-time interactive map of how the shocks and risks spread? No, I don't think we do.
Well, still a lot of work to be done then, Simon. Thank you very much.
Thank you.